Hello Accounting 101 students. In this video, we will be discussing accounts receivable with our question number 4 in our Chapter 8 end of chapter practice. So in this problem, we are given the balances for a few accounts. We have the balance for accounts receivable, credit sales, and the sales returns and allowances. And we need to record the journal entries given 3 different scenarios. So I'm going to start off this problem by drawing out the T account for the balances that we are given at the beginning of this problem. We have our accounts receivable balance, which will be a debit balance. And in my problem right here, my debit balance is $76,000. We have the balance for our sales revenue account. So specifically, this problem wrote credit sales. We can assume that the majority of the company's sales are going to be on credit. So they are made on account. So this is our sales revenue account, which has a credit balance. In my example, this is $887,900. And then we have our sales returns and allowance account, which is a contra revenue account. So this account will have a debit balance. And in my example, this is $43,110. So we're going to be going through our 3 scenarios. In our first scenario, this company is using the direct write-off method. Okay, so if SkySong is using the direct write-off method to account for uncollectible accounts, the adjusting journal entry will be a debit to bad debt expense and a credit to accounts receivable. And with the direct write-off method, the company will just find out maybe a year, 2 years, 3 years after the sale has been made that a customer is unable or unwilling to pay a balance. And at that time, they would report the bad debt expense. But the problem is that the period that they would report the expense may be very different from the period in which the sale was made. So we think about our expense recognition principle, and that's one of the reasons why the direct write-off method is not acceptable under US GAAP. Also, the other issue is that with the direct write-off method, we assume that 100% of our accounts receivable will be received, the full amount, 100% of the time. So this poses a problem that our accounts receivable may be overstated on the balance sheet at each period if we do not assume that there could be some amounts that might not be collected. So this direct write-off method, you can include the dollar amount in the journal entry for the purpose of this example, but we really do not want to be using this direct write-off method. In scenario B, we are provided with our allowance for doubtful accounts. And in this example, there is a remaining credit balance of $1,181. And we need to record the adjusting journal entries, assuming bad debts are expected to be 11% of accounts receivable. So in this example, we use the percentage of receivables method. And we're going to start off by drawing out our T account for our allowance for doubtful accounts. And you'll remember that this is a contra asset account. And you do want to learn this account title. So that way you use this as you're going through our class problems. In our allowance, we have a credit balance of 1,181. And for our adjusting journal entry, we need to determine what would be our estimate for our allowance for doubtful accounts. So to determine this, for Part B, we're going to take our accounts receivable balance, which is $76,000. This is given to us in the beginning of our problem where we drew out our T account for our accounts receivable. And we're going to multiply that by 11%. So this company is assuming that 11% of their accounts receivable may not be collected. So to determine our estimate, we're going to take 76,000 times 11% in our calculator. So we would estimate that 8,360 may not be collected. So this amount is going to be our estimate. So at the end of our reporting period, we would expect to see a credit balance to reflect this estimate of 8,360. So our adjusting journal entry is going to be made to really emphasize what would be the adjustment in order to get from our existing balance to what this estimate is. So I'm going to take 8,360 minus the credit balance that we have. And the difference is going to be the amount for our adjusting journal entry. So our adjusting journal entry is going to be for 7,179. And this will be reported as a credit to the allowance account. And at the same time, we're also going to be recording our bad debt expense. So in your problem, you're going to record a debit to your bad debt expense and a credit to your allowance for doubtful accounts in the amount of 7,179. And what this does is it reports your accounts receivable at the net realizable value. So the net realizable value is the amount that should be reported on the balance sheet because that reflects the actual amount that we expect to receive from our customers. So our net realizable value in this example would be the balance of 76,000 in our accounts receivable minus our ending estimate for our allowance for doubtful accounts. So the amount that we expect might not be received. And the reason why this is our estimate is that we don't know for certain which customers will not pay. If a company knew which customers would not pay, they would not make that sale to that customer. So the actual amount reported on the balance sheet would be $67,640. Also, with our journal entry, we notice that we're going to report a debit to our bad debt expense. So our revenue was generated this year. So that means that our expense associated with that revenue should be recorded in the same year. Next, we're going to move on to scenario C, where we have our allowance for doubtful accounts. But this time, instead of a credit balance, we have a debit balance. So one of the things that you want to really pay attention to in these problems is whether there is an existing credit balance or an existing debit balance. And this is something to really pay attention to in your homework, on your quizzes, and on your exam, what the existing balance is. So I always like to start off by drawing out the T accounts. So here's our T account. And this time for our allowance for doubtful accounts, we're going to have a debit, and we're given the debit amount of $520 in this problem. So this is our existing balance. And sometimes a company might have a debit. The reason for the debit is that sometimes their estimate could have been too small and there were more write-offs than the estimate, than the amount of the estimate. All right. So in this assumption for part C, we're going to come up with our estimate for our allowance for doubtful accounts for the end of the period. We do this by taking our accounts receivable balance of $76,000, and our percentage of receivables is 8% in this example. So we're going to take 76,000 times 8%. Which is 6,080. So for our T accounts, we always want to report our estimate at the end of the accounting period on the credit side. So 6,080 is our estimate. So we need to record our adjusting journal entry, which will be the difference between the existing balance and this estimate. So you'll remember that our adjusting journal entry, we need to make sure that we include this amount on the credit side. So we need to take our $6,080 and add $520, and our adjusting journal entry amount will be $6,600. So you can double check your work by taking 6,600 minus 520, and you'll see that this equals our ending amount. Our journal entry will be a debit to bad debt expense because we're using the allowance method. And of course, we're setting up our allowance for our next reporting period. And our adjustment is going to be for that difference. So that way we end up with this estimate for the next reporting period. And similarly, we would compute our net realizable value. So our net realizable value, which is the amount that the balance sheet would report, will equal the $76,000 for accounts receivable minus our estimate of $6,080. So we're going to go ahead and do the math here. So your net realizable value would be $69,920 reported on the balance sheet for this example. So thank you for taking the time for watching this video, and make sure you read through the problems very, very carefully to look at which method you're using and also what is the existing credit or debit balance.